Comes up, Tony. There we go. Welcome to another episode of Financially Fit Radio. I'm Cory Sickles here at Safe Harbor Retirement Group and Wealth Advisors. If you'd like more information about today's show, just give us a call at 614-760-0670 or feel free to visit our website at safeharboroh.com. And while you're on our website, feel free to click on that radio page. You can check out some past shows, as well as you can also subscribe to our podcast on Apple Podcast, Amazon Music, Google Podcast, and Spotify. And again, our job here is to be able to address any situations that you have. If you have a financial plan, we can put a financial plan in. If you don't have a financial plan, we can put one in place for you. And if you do have one, then we can provide a second opinion for you as well. All of our meetings are complimentary with no obligations. Today, we're going to talk about taxes and some of the savings changes for 2024. Tony, there's going to be a lot of numbers.
A lot of numbers today, but helpful numbers to help hopefully minimize our tax burden and understand what's going on. And I just have to say, I was so impressed at that big financial conference in Nashville. They had one of the key speakers. They only had 4 or 5 key speakers, and one of them really impressed me. You may have heard of him, Cory Sickles. Cory,
Yeah.
you got up and talked to all these top advisors in the country, and they were coming up to me afterwards going, "Oh, I want to do what Cory's doing." So you really impressed upon, there were almost 500 people there, how you've been helping your clients and how this show reaches out to your community with great financial tips each week. So I think that's fantastic. That was a good time. Of course, you and I both lived in Nashville previously,
Yeah.
so it was like a kind of a homecoming, seeing some old friends. But I've been great. How have you been, Cory?
I've been good, Tony. When we were down there at the Gradient Summit, it's one of those things where it's actually easier to actually get up and speak when you're not speaking in front of your peers.
Yeah, it is. That's
It is.
right. That's right.
It was fun. It was, I was able to kind of tell them what I'm doing from the marketing standpoint and what
Sure.
we're doing, just to be able to get information out, not only to my not only to, clients, but also here in the Columbus area as well. So,
Yeah.
it's always good to be able to do that. It's hard to believe, man. February is already rolling into here.
Yeah, it is. We're already well into 2024. I can't believe it. But so far, so good this year. There are a lot of things happening, financial changes coming. So you're going to talk about some of that today, tax and saving changes for our listeners out there. Where do you want to begin with this topic?
The one thing I just kind of want to make sure everyone's aware of, Tony, is, we have new tax brackets. Some of those tax brackets kind of expanded for 2024. If you're married, the 12% tax bracket now goes to about $94,300, and the 22% tax bracket now goes to about $201,000. And if you're single, it's going to be about half of that. So, just kind of be aware of how much you're spending, not spending, but how much income you are making, whether you're working or in retirement, because, there's a lot of strategies that can be put in place to make sure that maybe you don't bump into that 22 if you're right on that border of the 12%, between the 12 and the 22% tax bracket. And, one of the other things I think it's important to know as well, obviously they implemented standard deductions a few years ago, but that standard deduction for a single now is $14,600 and it's $29,200. And what I'm talking about is taxes there. So if you're married and you're not making, if you don't have, itemized deductions over $29,000, then you're going to be able to take that standard deduction here for 2024. And I think one of the things that, the government or the IRS really wanted to be able to do was to eliminate a lot of itemization. And I think they've accomplished that task because, less and less people are actually being able to itemize, kind of going forward.
Yeah. Well, and a lot of people, exactly. So that standard deduction most people have been relying on that since that change to the larger standard deduction. People don't itemize anymore. And so that's really changed a lot, a lot for the good for a lot of people, depending on what financial level you're at. Some people may be still itemized if they were in a different tax situation, but most people rely on that standard deduction now. So it'll be interesting. There's good and bad about a standard deduction, but I think because people take it for granted when maybe, you have to do the math, right?
Yeah, and with so many people not being able to, to itemize, Tony, that means you're actually benefiting really from being able to have that standard deduction.
Yes.
So,
True.
I think when they look at the masses, more people are being able to do that, which means you can actually lower your taxable income a little bit as well.
Yeah.
So, when we talk about retirement, obviously, Tony, one of the things that we can't talk, you always have to talk about because it's really the foundation of retirement income planning, and that is Social Security. So for everyone that's actually taken Social Security, you've received about a 3.2% raise here for 2024. And if you are working and you're, have the luxury of paying into Social Security, that limit now is $168,600. So that basically just means that if you make under $168,600 and all of your Social Security, you're going to pay that 6.2% going into Social Security. If you make more than that, then your maximum Social Security contribution for 2024 will be $168,600. Now, if you're working, it's a big, this is something that always pops up. How much money can I actually earn while I'm working and I'm taking Social Security, right? So,
yeah.
So basically, from 62 until 1 year before your full retirement age, that number is $22,320 per year or $1,860 per month. Now, when you hit
Which
that,
isn't a whole lot.
It is not a whole lot,
right?
But if you are taking Social Security, maybe you're working a little bit part time. It's good to know.
Yeah.
But obviously, if you're working full time, you might want to really think twice about taking Social Security. Again, for every $2 that you make over that $22,000, they're going to pull one Social Security benefit dollar as well. So you definitely want to be aware of that.
So why would you file if you're planning on working and making more than $22,000 of income in a year? Why would you file for Social Security early, lock in that lower amount when they're just going to take it back until a later date? You might as well let that roll up if you're making that money, is what you're saying, right?
Yeah, I mean, and believe me, I totally agree with what you just said. That's why I think before you trigger your Social Security, it's probably going to be helpful if you sit down with an advisor to make sure you're actually doing the right thing, because you don't want to lose money. You're locking in a lower type of benefit, and obviously that can hurt you a little bit later on as you kind of go through retirement as well. Now that number does increase, that 1 year before full retirement age. And that number is now $59,520, or around almost about $5,000 a month of monthly income. But if you do exceed that, for every $3 that you exceed that by, they're going to take $1 away from you, as from there. And of course, once you reach your full retirement age, you can make as much as you want you can make as much as you want and receive your full benefit from Social Security.
Yeah.
So, if you plan on working and you're not your full retirement age, just seek some advice to make sure you understand exactly what you're doing before you trigger those benefits. You only get one shot at it, so you want to make sure you're doing it the right way. And, we're definitely glad to be able to, sit down with you and make sure that you're doing the right thing, not only for you, but for you and your spouse and your family as well.
Yeah. Yeah, I think that's so important. So obviously, you want to make sure all these ducks are in a row. And like you said, it affects your family. I wouldn't make any of these moves, Cory, like filing for Social Security, doing this tax planning without talking to a financial professional to get the broad overview. I mean, I realize you're not a CPA, but what you do is look at the big picture and future taxes and work alongside CPAs and tax professionals to make sure your clients and people you talk to aren't paying too much of a tax burden or going to have a burden in retirement. I mean, a lot of people don't understand how this all works once they hit retirement. They assume they're going to be in a much lower bracket, so they don't need to worry about taxes. But that isn't always the case, is it?
In most cases, when you retire, you're going to probably be in the same tax bracket that you were.
Yeah.
It might be
Yeah.
a little bit lower, but odds are you're going to be in that same tax bracket. And what a lot of people don't realize also, Tony, is that Social Security can be taxed. In most cases, it can be taxed up to 85% of whatever income tax bracket you're into. So again, you want to make sure you're going to be able to sit down. Here's where it really comes into play long term, Tony, is you're going to be able to sit down with an advisor like myself. We're going to be able to put together an income plan for you. And the earlier that you come to us, the more that we can actually help you. That's the one thing that I would say. But, one of the things that we really try to do is make sure that you're going to be tax efficient in retirement. The less money that you pay in taxes means the more spendable income that you have. And if you don't plan for that and you just, retire one day and you have no plan, odds are you're going to be probably paying the most possible taxes that are possible. So, who likes to, no one likes to be able to pay Uncle Sam any type of money, especially money that you shouldn't be paying. So if you have a tax strategy going into retirement, you're going to be better off long term.
Yeah. Yeah, that's true. You are. And you have to look at that. And that's the thing that, again, I point to. I wouldn't want to go it alone. That's where you come in because you help people plan for. You're looking at the big picture, looking down the road, right?
That's exactly right. And, and the nice part about working with an advisor, as you go through retirement or as you're planning for retirement, things change. And not only personally, but from a law or from a tax standpoint. And, we're going to be up to date on some of those things. And just like anything else, you might have to make a little bit of a change or a shift in order to be able to accomplish your ultimate goal, which is to be able to have the best retirement that you can, but you also want to do it the most efficient way possible, not only from an income standpoint, but also from a tax standpoint as well.
Yeah, that's a big one from a tax standpoint. Taxes can get complicated. A lot of times people just think, oh, my taxes are good. I just give my stuff to the CPA and let them handle it each year. But that's not what we're talking about here, is it?
No, I mean, really what you want to be able to do is, really you should be planning over the next 6 months really for 2025 taxes. Really. And because 2024 is already here, and the odds of you probably be able to make any changes or shifts are probably going to be a little bit too late. So by working with an advisor, by working with a CPA, you'll be able to maybe change some of the things that's going to make you not only tax efficient today, but also tax efficient tomorrow in retirement.
Yeah, yeah, I think that makes sense. So we want to have a strong retirement, and why not minimize that tax burden and maximize our benefits?
That's exactly right. And when we start talking about maximize your benefits, just one thing I kind of want to, for our listeners and viewers to be able to just to think about, if your full retirement age is 67, which means you were born after 1960, and you file for Social Security at the age of 62, you're basically taking a 30% hit on what that full retirement amount could be. Now, every year that goes by, it jumps a little bit less, but 30% is a pretty big hit on a monthly income number. Would you rather have, a 3.2% increase, Tony, off of $1,500 or off of $2,500? So that money adds up not only today, but long term as you receive those cost of living adjustments as you're kind of going through retirement as well.
Okay. Yeah. And I like that. The cost of living adjustments, that just makes me think of inflation, which is not fun.
Inflation is going to be there not only today, but it's going to be there forever.
Yeah, that's the problem. It's like death and taxes. Inflation happens, right? The cost of goods has always gone up. With the exception, I always point this out, with the exception of televisions, the cost of goods always goes up. There's only one exception to that rule that I know of. Maybe there's another out there, but TVs are the only thing I've seen in my lifetime actually drop in price. So,
and I can remember, Tony, when flat screen came out, I mean, there were thousands of dollars.
Thousands. Like you could spend $4,000 on a flat screen plasma TV.
If not more.
Yeah.
Yeah. I mean, depending on how big it was. I mean, but yeah,
Even,
that they have gone down. Everything else has gone up.
Right.
You're right about that.
Even those big console units our parents used to buy, the TVs back then, my parents paid more for their old tube TV than I did for my 65-inch flat screen. So back in the day. So that's really crazy. But Cory, before we move on, let's take a moment to let our listeners know how they can get a hold of you. I know you offer a no-charge consultation, and you'd love to hear from our listeners out there, answer any questions they may have.
Yeah, for our listeners and viewers out there, just give us a call here at 614-760-0670, or you can also visit our website at safeharboroh.com, and you can schedule a complimentary no obligation meeting with us. If you have a financial plan in place, we'll review it, provide you that second opinion, and if you don't have one, we'll put one in place for you. It's so important to be able to have a financial plan in place. Not only today, but as you kind of go through retirement. If you're already retired, for example, and don't even have a financial plan, I think it'd be worthwhile to sit down with us just to see, are you going to be in a position where you can potentially run out of money? People are living longer. We want to make sure that your retirement's the way you want to live, and we want it to be happy. So just give us a call here at 614-760-0670, or again, visit our website at safeharboroh.com.
All right. Well, thanks for that, Cory. Now, today we're talking about tax and saving changes for 2024. This is a big topic. You've already given us a lot to think about. What's next?
529 plans are something that I think a lot of people do. And I think a lot of grandparents actually do it, for their grandchildren.
Yeah, they do.
So for this year, you can do $18,000 per year per child. As a gift. So that's how much you can actually put in there. Obviously, it's going to be a little bit different on what you can actually write off on your actual taxes, but you can put around $18,000 this year for a 529 plan. When we start talking about gift and estate taxes, kind of leading into the same thing, Tony. So if you do want to gift something, you can gift something $18,000 per person, and the tax exemption is now about $13.6 million, before you actually have to start paying estate taxes as well. So that has gone up as well. So the next thing I kind of want to dive into, Tony, which is something that everybody should be doing out there, and that's actually saving for retirement.
Yeah, there you go. We have to save for retirement. This is always a hot topic. Am I saving enough? How much should I save? How do I save?
Exactly right. So first of all, we're just going to kind of dive into what the traditional and Roth IRAs contributions are. So this year they're jumping up to $7,000. If you're over the age of 50, they throw another $1,000 on there, so you can actually save around $8,000 per year. Again, work with your CPA, work with your financial advisor to make sure you're taking advantage of that if possible, to make sure you're actually putting it in the right bucket. There are, obviously there are some limits on the income that, if you do make too much money, you might not be able to contribute to a Roth. I don't want to throw all those numbers out there, but again, talk to your advisor and CPA to make sure you're taking advantage of that. But obviously the most common way that people actually save, Tony, is qualified plans, or like your 401k or your 403b or your thrift savings, things like that. So when we start talking about that, the max that you can put in this year is $23,000. And if you're over the age of 50, you can put in $7,500 as well, as that potential catch up. If you do have a simple IRA, it's $16,000 and the catch up's $3,500. But the whole point of this is to be able to make sure that you're saving, but more importantly, that you're doing it the best way as possible too, Tony. We've talked about this so many times on the show. I'm a firm believer, pay your taxes now, because they're only going to be able to go up. And really what I'm talking about there is, you can actually contribute up to $23,000 or $30,500 this year into a Roth 401k, if that's what you want to be able to do.
Yeah,
If
if
your
you're over
company offers
50.
it, yeah, if your company offers it, take advantage of it. That's tax-free money. You will pay taxes today, but over the long term, that you're going to get that compound interest, you're going to get that growth going, and all that money is going to be, tax-free for you when you're in retirement. We do so many Roth conversions here for our clients when they actually retire. And the reason why is such a large percentage of their money is in those 401ks, or what I say is tax deferred, savings. And then when you do retire, your income's a little bit lower, but all you're doing now is now you're converting so much money, from one bucket to the other bucket. And I think that there's just a better way to be able to do that. And that's, by working, with an advisor, making sure that you're contributing to the right way, with your company or your employer retirement savings plans.
Yeah. Yeah. I think that it's really important for people to understand that they need to be contributing. I just had this discussion with my son, who's in his first full-time job out of grad school. And he's like, well, my company doesn't offer a match for the first 6 months, so I'm not going to contribute anything for the first 6 months. I'm like, start that 401k as soon as you can, and then make sure you're contributing as much as you have to at least get the full match when it does kick in, and then make sure you stay in it long enough to be vested. I mean, though, that was my advice, and that's what you've talked about on the show before. You've told me all of those things, right?
Yeah, I really think that everyone should be putting in a minimum somewhere between 10 to 15% on an annual basis into
Yeah.
your retirement savings account. Um, if they match, you got to at least put that in. That's free money you're giving up. But here's the easy part about it. Just like when you were talking to your son there, Tony, the one
Yep.
thing is, if you start out and you're putting in a certain percentage into it, you're never even going to see it. So that's not even going to be income that you're really living off of. You forget about it. You're going to get that annual. Hopefully, you're going to be able to get some type of annual increase or percentage. Maybe it's 2, 3, 4% per year off of what you're making. And all of a sudden, what you save is up 2 or 3, 4% as well, because you don't even see it. So, it's one of those things that where make it easy. Start from day one. You don't even see it coming to you. It's automatic. And next thing you know, your savings is going to grow significantly as you kind of go through your working years.
Yeah. Yeah. And there you go. And you want to take advantage of that compounding interest you're always talking about, Cory.
That's exactly right. The earlier that you start saving, the less you truly have to save in order to make your retirement number. And I know it's tough out there. People graduate, they get married, they buy a house, you have kids, you pay for college, but you still got to be able to find some way to be able to stash some money away, just so that you're going to have the retirement that you want. Don't put yourself in a position, where you're having to really try to save when you're 55 and you only have 10 years to be able to save. It's a lot easier to save when you have 30 or 40 years before your retirement date.
Yeah. Yeah, and that is a great point, Cory. You have to look at your time horizon, and of course, it really doesn't matter what your time horizon is as far as when you should start saving, because it's like I always say, when's the best time to plant a tree? 20 years ago,
Exactly
right?
right. Yep.
Now, when's the second best time to plant a tree? Today. So
Right.
if you haven't started, start now. Today is the best time to start saving. Obviously, I bet to a single person, everybody you talk to who comes to you with their finances says, and you lay it all out on what they need to do for retirement, they say, I wish I would have known this when I was 20 or started this when I was younger, right?
Exactly right. I mean, yeah, a lot of people make mistakes. There's a lot of good, there's a lot of individuals out there that are doing it the right way. But
Yeah.
I think the majority of the people out there probably aren't saving enough. And, it's only going to get more complicated, especially with if Social Security has some type of, reduction at some point in time. There's obviously there's more people that are collecting than are actually working. So, it's just something that you don't rely on Social Security to be able to get you into retirement. make it, do what you do. And that's being able, you can take control of it. And the way to do that is to save as much as you possibly can per paycheck and per year.
Yeah. Yeah, that's a really good point. You know what? We're out of time, though. I just noticed that. It flew by today, Cory. Is there anything you want to add before we go?
For our listeners out there, just give us a call at 614-760-0670. Or again, you can visit our website at safeharboroh.com. We're here to help and guide you to make sure that you have the retirement that you want. And the best way to be able to do that is to set up a complimentary, no obligation meeting with us. And when you do come in, we'll put together a financial plan. If you don't have one, if you do have one, we'll be that second set of eyes and provide a second opinion. There's nothing wrong when you actually come in and sit down and try to put together a retirement plan, not only for today, but for the future. And again, just give us a call at 614-760-0670 or visit our website at safeharboroh.com.
All right. Well, thank you so much, Cory. Listeners, thanks for tuning in. That does it for today's episode of Financially Fit Radio.
Join us again next week for another episode of Financially Fit Radio.